According to Rafi Farber, the inflation we are experiencing today isn't something that's just a recent phenomenon. It is, in fact, nearly 90 years in the making. He traces the origin of this inflationary trend back to 1933, a pivotal year in financial history. Why 1933? That's the year when Franklin D. Roosevelt, or more likely, those advising him, shifted the dollar's fixed exchange rate from $21 per ounce of gold to $35 per ounce. This was a strategic move designed to counteract the deflationary pressures of the Great Depression. The value of gold was devalued by approximately 60%, creating an artificial reset that, for a time, brought balance back to the economic system. However, this manipulation of the currency didn't stop there. Farber points out that the U.S. government and Federal Reserve continued printing money at a steady pace, with a charade that lasted until 1971. For decades, the government claimed that the price of gold was pegged at $35 per ounce, even though this no longer reflected reality. In 1971, the truth came to light when the U.S. finally abandoned the gold standard altogether. But by then, the damage had already been done. The inflationary pressures that began in 1933 were set in motion and continued to build throughout the decades. Farber emphasizes that this isn't a short-term phenomenon, and certainly not a situation that can be blamed on the last decade or two. It's much older and far deeper rooted than most people realize. The effects of the last 90 years of monetary policy, characterized by endless money printing, are now visible for everyone to see. Yet, Farber warns, this situation is reaching a breaking point. As the dollar continues to lose purchasing power, things will inevitably get more expensive. The grinding reality of inflation is accelerating. Reflecting on his personal experiences growing up in the 1990s, Farber remembers a time when most people, especially in middle to upper middle class neighborhoods, were not drowning in debt. There was some financial struggle, but people could afford to save, were mobile, and generally enjoyed a high standard of living. But everything began to change around 2006 and 2007, as more and more people started to take on massive debt, especially in the form of mortgages. This led to the 2008 financial crisis, and since then, the trend of increasing debt has only worsened. Now, Farber notes, debt is widespread. Most people, except for the wealthy, are in some form of financial strain. Debt is pervasive. And this, according to Farber, is where the system begins to break down. We are at a critical juncture, and we are heading towards an inevitable implosion. While it's impossible to predict exactly when this will happen, Farber believes that the effects will manifest gradually at first. It could take months or even a year, but with so much turmoil simmering beneath the surface of the global monetary system, something could trigger a collapse at any moment. When this tipping point is reached, Farber predicts we will witness an orderly decline of the dollar's purchasing power. This doesn't necessarily mean the dollar will collapse against other currencies, but rather that it will lose value in terms of the real goods and services that people buy. Everyone can see this coming. Even the most ardent proponents of fiat currency recognize that the current system cannot be sustained. The accumulation of debt is out of control, and as Farber explains, such a system can never last. It goes against the fundamental laws of nature, where balance is required. Unfortunately, the current financial system is not balanced. It's built on an ever-expanding mountain of debt that cannot be repaid. However, there is a point at which this process becomes undeniable. When it becomes clear that the dollar is losing its purchasing power, Farber believes that the decline will speed up drastically. This is not going to be a slow erosion of value. It will be a sharp, sudden collapse. And when it happens, it could happen very quickly, possibly within weeks or even days. Farber draws comparisons to historical instances of hyperinflation, like what occurred in Weimar Germany in the early 1920s or Israel in 1984. These were isolated cases where local currencies experienced hyperinflation, but they were always backed by another, more stable currency. The big difference today, according to Farber, is that the dollar is the global reserve currency, and it is the dollar itself that is in danger of crashing. If the dollar fails, the world will have to find something to replace it. This could mean a return to gold, or perhaps a complete collapse of the global monetary system as we know it. The scenario that Farber envisions is one in which the global financial system implodes, leading to a shift towards private currencies. While this might be a more sustainable solution in the long term, Farber believes it will create immense chaos in the short term. This scenario could unfold much like the hyperinflation witnessed in Weimar Germany, where inflation spiraled out of control in a matter of months. But the technological environment today is vastly different. Unlike in the past, when money had to be physically distributed via trains and trucks, today's monetary transactions are instantaneous. Digital currencies such as Bitcoin and payment systems like Apple Pay can allow people to spend money in an instant. If a collapse happens, there won't be any delay in its effects. Food prices could double in a month, then double again the next month, and then within days, it could all come crashing down. Farber stresses that we have never experienced hyperinflation in this kind of technological environment before, with instantaneous money transfer and a currency that is the global standard. The consequences are difficult to predict, but Farber suggests that protecting yourself now is crucial. Once the tipping point is reached, it may be too late. As the dollar continues to lose value, Farber explains that the only reason it still has any purchasing power is because it can still be exchanged for gold, albeit on a limited basis. However, if everyone were to suddenly demand their gold, the price of gold could skyrocket. Based on Farber's calculations, if everyone tried to exchange their dollars for gold, the price of gold could potentially reach $40,000 per ounce. This is because, as the dollar loses its value, it would take more dollars to back the same amount of gold. But, according to Farber, it's not so much the price of gold that is increasing, it's the dollar that is collapsing. This situation could quickly escalate, with the price of gold moving from $2,000 to $3,000 in a single day. Once this process begins, Farber believes that there won't be any stopping it. The free market will push the dollar to its natural parity against gold, based on the amount of gold held in Fort Knox and the Federal Reserve's balance sheet. This process is already underway, but the timing is uncertain. Farber warns that most people, including those who are currently speculating in digital currencies like Bitcoin, don't understand the fundamental nature of money. Farber's message is clear. When you exchange your money for goods, you are really exchanging gold for those goods. Even if you don't see it directly, gold is still the underlying basis of the currency. The big financial institutions, which may not regard gold as money, are the ones manipulating the price of gold to extract profits. But gold is money, always has been, and always will be. As the dollar's purchasing power continues to decline, Farber predicts that the price of gold will rise. This is not because gold is becoming more valuable, but because the dollar is becoming less valuable. Eventually, the price of gold could reach $30,000 per ounce or more. At that point, the entire monetary system will shift, and gold will once again become the standard by which all value is measured. Farber's advice? Protect yourself now, before it's too late. The dollar is on its way out, and the chaos that follows will change everything.